And it looks like we're live. Hello, DeFi Alpha viewers. This is my first attempt at a live stream, so a bit of feedback in the comments after you've watched the video would be appreciated. Hopefully, a lot of people got wrecked in Terra Luna, and the rest of the market has rolled over since then. So it's been a tough time. A tough time for everyone, and some of these lessons we can learn from should hold us in good stead moving forward. So, number one was thou shalt take profits. That's something, unfortunately, I didn't do particularly well myself. I did actually take a lot of profits, but I compounded them into more Luna and other cryptos, and obviously everything's pulled back significantly. So I think taking profits and getting it into something in the real world, into fiat, helping to pay down some debts, pay off your mortgage if you've got one, maybe look at upgrading your car, something like that, that provides utility in the real world is not a bad way to go at all. And hopefully during the next cycle, I learn from that and actually do take profits from time to time. One concept I have seen people do is try to keep 20% of their portfolio in stablecoins at any given moment. And basically it helps you to buy the dips if it's a long trend of accumulation. So when your crypto goes up in value, you sell some off to balance it back out to 20%. And when the cryptos go down in value and your stables end up growing in size relative to your portfolio, so they move up to 30%, you would take that difference out and put it back into your preferred cryptos. So it's a good way to balance out basically the peaks and the troughs, and always have some dry powder to pick up some cheaper tokens when the market does pull back. So the second one was thou shalt not buy in euphoria. So this is a pretty tough one to actually quantify, but the fear and greed index, the crypto fear and greed index, is pretty useful. It's not perfect, but it still does give you an idea when things are getting a bit toppy. As we can see here, we're down at basically rock bottom lows. I think we had an all-time low of 6 yesterday or the day before, which is basically as low as it's ever been. You can see it's been down here for quite a while now, which does usually indicate we're getting close to a local bottom. The other thing to make note of, it's not perfect on the upside either. So it was peaking up there around sort of October, November, which is when we did have our cycle top. But you can see it was even higher, almost a full year earlier. So it's not perfect, but it is a tool to sort of use. Another thing to just sort of gauge is your own sentiment. Are you getting euphoric? Are you starting to look at Lambos online or whatever? And, consider in those moments, perhaps it's often best to do the opposite of what everyone else is doing. So rather than FOMOing in, maybe take some chips off the table. So that's the second one. Third one, thou shalt not invest more than you can afford to lose. So, you hear this trotted out time and time again, and anyone who's overinvested and now has bills to pay and, interest rate repayments that are getting higher and higher, if you don't have any dry powder left, you're going to be forced to sell your crypto assets at the worst possible time. And that's how a lot of people end up capitulating. And some people, they get so badly wrecked that they end up leaving the industry forever because they've just been so badly burnt by not managing their risk. Now, I haven't invested more than I can afford to lose, but it's gotten pretty close. Probably back to where I started basically in terms of what I've been able to pull back out and what I invested over the last 2.5 years. So it's definitely one to keep in mind. Again, take profits on the way up and manage your risk. And, there are tax implications when you sell as well. I had heard a lot of people, especially Aussies, were like, oh, I was just waiting until the 1st of July till I cashed out. I was in that exact same boat. But sometimes, you're better taking the chips off the table when you're well in front. And, if you pay more tax, that's okay. It's because you're making more money. So next time around, I probably will be more aggressive at taking profits, even if it's inside that 12-month capital gains period. So that's just something to keep in mind as well. Also, do not forget to diversify. So they say, concentration creates the wealth, and that's what I was going for with the Luna ecosystem. But because I had about 80% of my portfolio in that ecosystem, I've taken a pretty big loss in the short term by not realizing some of the gains I was sitting on. So diversifying is a way usually to retain wealth. Unfortunately, at the moment, the global macro conditions are so bad that just about everything is tanking, from stocks to bonds to gold. and obviously crypto being a risk asset is being completely hammered at the moment. So there was no real safe haven. Unfortunately, a lot of people trot out the line that cash is trash, and I was, of that opinion myself due to the rampant inflation. But cash is king in a recession, so you can pick up cheaper assets when you're sitting on a nice big bank of cash. So that's something that, I wish I had managed a bit better. I should have diversified into cash to de-risk things a bit more. I do have some diversification, thankfully, but most of what I have left over is some concentrated bets on some gaming and metaverse NFT plays. So they're holding up pretty well relative to Ethereum, but everything's down 75+%. So still a lot of wreckage going on. Next one, thou shall not keep a crypto in a centralized exchange. So as we've seen, a lot of people have had their funds locked up in Celsius, which is quite alarming, very concerning for those people. So, I understand why people use centralized exchanges. There's definitely that benefit of it being easy. It's convenient, and a lot of people are scared, shitless basically of taking self-custody. So I do sympathize with that point of view. Personally, I have my assets spread amongst a bunch of exchanges and some hardware wallets, and so stuff on chain, just to spread my risk. So, I don't have all my eggs in the one basket. Even though I had a lot in the Luna ecosystem, the rest of my assets have been pretty well spread out. So protect yourself in that sense, and have a good think about using the earn options that you're starting to see pop up in our centralized exchanges, because basically that's a borrowing and lending market, and if it's done in a centralized way, so CeFi, you don't have any transparency as to what's going on. And that was the problem with Three Arrows Capital blowing up. They had a lot of OTC deals that off chain that we can't see, that's not transparent, and I don't think people realized how much they'd borrowed from various parties, and a lot of it was under collateralized, so that those losses are going to be worn across the whole ecosystem, the whole industry. And a lot of VCs and institutions are actually getting wrecked as bad, if not worse, than retail. And some of them have been for sellers, Celsius included. So that is, a key thing to keep in mind. And a lot of that is because of this next step. Lots of people were over leveraged. And as they say, when the tide goes out, we can see who's swimming naked. And I've heard people describe it at the moment is that we're in a bit of a nudist colony. Everyone was over leveraged in crypto. We're all too bullish. And I guess that's why we've had such an extreme pullback, because a lot of the price appreciation was based off of leverage, all the rampant money printing from the Fed post-COVID. So that's just something to keep in mind. A lot of people I'm seeing already saying, I'm going to buy the dip really hard, leverage back up. And it's just like, you're just asking for trouble, especially in this volatile environment. I've burnt myself so badly with leverage, especially within Luna, because a lot of the leverage is based around the Anchor protocol, and a lot of lunatics were probably being a bit irresponsible with their looping, and myself included. So I'm going to do my fundamental, analyst, I guess you would say, and I love buying things that provide yield, kind of like traditional businesses, and that was sort of my investing background in stocks. But doing my own research for me over the next little while is going to be understanding how to read charts a bit better, just to try and time entries, to try and de-risk when I'm buying in, and maybe ladder in at lower prices if I can set some limit orders that get hit based off the charts. So basically just dollar cost averaging blindly in is one strategy, but if you've done that over the last couple of years, you're probably actually underwater at the moment. So I'm going to be a bit more sort of calculated, I think, when I execute my buys going forward. So another one for me was, don't lose sight of your long-term goals. So when I first got into crypto, I just bought a house, and I decided, hey, if I keep some of my sort of equity and use it to invest in crypto, rather than having paid off more principal of the house, there's a good chance that over a period of time that will grow and I'll be able to pay my house off faster. So that was my initial goal. And things were going so well that you get this lifestyle creep, and your goals suddenly get more lofty, and you keep raising the bar and raising the bar and raising the bar. So this was, I believe, a classic mistake of a lot of people. This is my first full cycle. I sort of joined in a bear, so I was in some great positions. But I kept, I got greedy. I kept upping the bar, and I didn't take too much off the table, which I should have. So, I feel more rounded for it. I feel like that by the time I come out of the next cycle, I hopefully will have earned it more, and I'll appreciate it more as well. So with crypto, you often get desensitized to the numbers on the screen and what it translates to in the real world. And it's only now that I've been forced into selling back into stables that's really hitting home. It's sort of like, you know, I was in a position where I really could have changed my sort of midterm life and really helped my family and my circumstances. But I got greedy, sort of like, hey, if I just keep writing this up a little bit more, another 2x, and I could be sort of effectively retiring. And it's like, was that really my original goal? No, it wasn't. It was just to basically clear myself of debt, being able to sleep better at night, knowing that, I didn't owe any money to the bank, and having the opportunities that opens up. So that's one to keep in mind of as well. So, during this bear market, work out what your goals actually are and try and have a plan and stick to it. And, you don't have to cash out entirely if it ends up being better than you first expected. But maybe, tick a few boxes along the way, but keep some in the game so you've still got some of that upside. Another thing that I've heard people do, which is a really clever tactic, if you're particularly bullish on an asset, but you're already sitting on some big gains, one thing you could do, for instance, is sell, 100% of it, take 20% of that gain and then use it as a 5x leverage long. So you've still got the exact same upside exposure that you had. So if things double and triple from there, you're not going to be in pain because you missed out and you got off the train too early, but you've already locked away, 40% of your gains, 80% of your gains, probably closer to 40% once you pay your taxes. But that's one way you could do it as well. I haven't done it myself. And again, you really got to know what you're doing with leverage. So I've never been really one to sort of long things and short things. Most of my leverage has been borrowing against my assets and buying back the same assets or other crypto assets, maybe a bit further out on the risk curve. High risk, high reward. But as you can see, the whole industry's got it badly, badly wrong. And we've had a big unwind. And I think basically the market is telling us any leverage left in the system is likely to be cleared out over the next 2 or 3 months. So that shall not be a bag holder. So that's another one. It's sort of, I feel relieved because I've actually sold off a lot of assets, even though, a lot of them are 80, 90% down from their highs. Thankfully for myself, most of what I got in at was pretty early. So some of them were actually still in the green for me. Some of them weren't, obviously, but, that helped a bit. But it certainly clears your mind when you're sitting on a bank of cash and you're in a position where you can meet some living expenses, to sustain yourself for the next little while, but you're also in a position to buy the dip if things really nuke. And it looks like, there's a capitulation event that's in. I don't believe we're there yet, but I could be wrong, and I'm willing to buy back higher once there's a trend reversal, if that's the case. So last one is, never give your seed phrase to anyone. So that's just simple advice. Be super careful, guys. There's so many scammers in the space. I've been scammed myself, social engineered, thinking I was talking to, a trusted friend, and I wasn't. I was totally duped, and it was just through my own sort of being glib and flippant about things, and that ape culture sort of, ape into something without thinking. That was exactly what was going on for me. So I've made an awful lot of mistakes in this cycle. I've still done okay. I'm still here. I'm still breathing. I've learned a lot, and I'm looking forward to sort of doing it all over again, because the bear market is really where the gains are made, and I find it far more enjoyable. It's far less noisy, way less hypey, and the people that hang around are usually here for the long haul, and this is when most of the building is done. So there are a lot of opportunities if you're willing to get involved, have some good follows, jump into Discords and Telegrams, ask questions, but just be careful. If anyone DMs you first, 99% of the time, it's a scammer. So just keep that in mind and be super careful. So I just want to have a real quick chat about the market itself. Again, I'm not big on the TA. It's something I'm trying to learn. But I signed up to CTO Larsson's Larsson line because I needed a plan. I didn't have one last cycle. I got into some good positions, as I said, and I just didn't take it. So this is his indicator here. And basically it's a long-term trend. It depends on the time frame you're looking at. So we're looking at the daily here of Bitcoin. And he also recommends you use the volume profile on the right here. So the one thing that I'm worried about here is you can see there was a bit of resistance around 28K, It shot straight through that, and then there's really not much resistance here. We didn't have a lot of price discovery or a lot of accumulation and retesting when we broke through this. It just went straight up over a few weeks. So the inverse has happened here because there's no volume to support it. So we've hit this nice bit of volume here, and that's where we've bounced from. But I'm worried there's still not much. It's looking pretty skinny here as well, as we ripped up from, you know, from about 10 or 12K post-COVID all the way up to about 40. So, you know, if this breaks down, and I suspect it possibly could because I'm really worried about the macro environment being a drag on crypto, I'm thinking, you know, this volume profile here looks like it makes sense for some logical resistance. But again, I'm learning all of this as I go. If this is the bottom, fine, I'm happy with that. I still have some exposure to crypto, and I will reconsider dumping a bunch back in when this indicator turns yellow again, meaning there's a trend reversal, because you can see what happens. And if you followed this, you were getting out pretty early here. You know, you were getting out probably around 55K. You might have jumped back in here and got stopped out and lost a little bit of your portfolio, but by and large, you've ridden us all the way down. In fact, if you really wanted to, you could have opened a short here perhaps, or even just hedge your position. Maybe don't get out, but hedge it with a short. That's another way you could play it. So I'm sort of interested to see how this is going to play out, this tool. And again, it's a CTO Larsson tool. It's called the Larsson line. It does cost money to essentially get access to it. It comes with a little course. I think it's about $3,000 US. That's not cheap. It does come with about a 21-day course. The course is more about his methodology and how he uses it and your mindset around things, more than, hey, this is technical analysis. You know, this is what, you know, certain trends are, all that sort of stuff. So I need to learn a lot of that myself. So this makes a bit more sense in the context that CTO Larsson actually provides in his course. So he uses 6 or 7, you know, key kind of indicators, you know, things like double tops, double bottoms, ascending triangles, descending triangles, all of that sort of lingo, which is largely new to me. So I'm sort of going to be learning that. But, you know, I do enjoy this guy's content. It's good. It comes from a sort of, he's often a bit of a voice of reason. I find that he often counter to what everyone else is saying, which is interesting. So, you know, consider giving him a follow him on Twitter and YouTube. He does put a lot of free content up. If you do sign up to his course, you do get I think a weekly TA PDF email that sort of gives you his take on the market, but largely it's just following this trend here. So the other thing I wanted to mention is, without trying to rip off CTO Larsson here, you know, as I've said, I've paid and I'm happy to sort of pay for a quality product, but Yoda Research looks to have basically worked out the secret sauce here that CTO Larsson uses and is now doing a bit of back testing on his own. That it basically looks almost identical to the Larsson line. So I've compared it to my own charts. And as you can see, you know, when it goes green, that's the uptrend. When it flips red, that's the downtrend. So, you know, give Yoda Research a follow. He may even be releasing this for free. So yeah, $2,300, sorry, for CTO Larsson's course. It's still considered, I'd still consider that to be reasonable value, but it just depends, you know, what you want to achieve out of it. But even if you're just curious, you could start following this, start following CTO Larsson. He does show this in most of his videos each week. So even following it for free, you're going to get some good value out of it. And then over time, you might get the conviction or be in a position where you actually pay for it. Basically, it's a tool that basically comes up inside your trading view here as an indicator. So the Larsson line. And, you know, it might be a nice thing to have in your tool bag. Even CTO Larsson himself says, like, this isn't for everyone. If you find a better indicator, you know, use it. And it's really just to have an extra tool in your tool belt. And I think it's just a smarter way potentially to accumulate your bag over time rather than just DCAing in all the way up and down. That's a nice thing to do if you really don't want to think about it. But if you can sort of time it, you know, DCA in here, maybe you're thinking things are getting euphoric. So rather than just putting my continual DCA in, just hold it in cash and then later in on the downtrend. Maybe that's something you could do. Or, you know, later back in when it flips. So just some options there. So anyway, guys, this was just more or less just wanted to test out how the live streaming goes. I've never done it. Hopefully this comes out okay. I'll give it a watch and see how I can refine things. and it's just a way to get content out a bit more regularly. So I may update the video in the comments and link to all this stuff just so you can see how it all went, and if you want to follow up on it yourself. And yeah, guys, if you